Professor, welcome, and thank you very much for adjusting your schedule on short notice. We got you down here basically in a matter of hours because there's so much going on in the markets. We thought it might be a timely time to get you down here. And I just was thinking, actually driving in on the way, the thought of having a professor of philosophy on a financial talk show, I would have laughed at that a few years ago, but here we both sit. And what intrigued me was looking at a couple of the articles you've written, the essays and letters to the editor. One in particular, you were talking about the term casino capitalism. And right off the bat, when I saw that, I thought, well, geez, that sounds pretty bad. And yet you write that it's probably even worse than I interpret just looking at it, because the casinos really aren't doing anything worse than what Wall Street's doing.
Well, I think in a sense they're not doing as bad a thing as Wall Street is doing in some respects. Both casino and capitalism, I think, are wrong. It's a popular phrase. People love to say it. You've got the two hard C's, casino, capitalism, and you can spit it out. But a couple of things about casinos. First of all, you have to bet your own money in a casino. Whereas some of the most egregious things that have happened on Wall Street, it's been firms betting other people's money. And that's a frightening aspect of it.
And would you argue even not only somebody else's money, but getting backstopped or backed up by you and I,
well,
the federal government?
As it turned out, yes. When we realized that some of these institutions were too big to be allowed to fail, that's actually, I think, the better phrase, not too big to fail, but too big to be allowed to fail because of the impact more widely on the system. Yeah, then it's our money that backstopped them.
But you know, I think you'd agree, Wall Street's been known for a century or two. Wall Street's where you went to take risk. You took risk with your capital, or Wall Street firms risked their own capital, or others, as you might imply. Is it just a case that Wall Street became too risky, or did something else change?
Well, I think something else changed fundamentally, and the second part of the particular article you're talking about, it's not a casino and it's not even capitalism. When we think about a capitalist economy, we look at risk and reward as being inextricable. You take a risk with your own resources, and if you are successful, then you reap the reward. What's happened, and what in particular happened in the run-up to the fiscal meltdown, is that risk and reward, first of all, they got separated, and then they got reversed. So if we look at the subprime mortgage crisis, at the lowest level, we had salespeople out selling people mortgages that they really couldn't afford. Now, why did they do that? Well, they got paid a commission, and they bore no risk because they just passed it up the line to their mortgage originator, Countrywide, for example. Countrywide then sold it to various Wall Street firms, so it collected a commission and passed on the risk.
And I see where you're going, but is the answer more regulation, or just enforcing the regulation that was in place?
Well, was in place would have to go back to Glass-Steagall, perhaps, and to the Commodities Futures Act of 1990. So I don't think that there's an easy yes or no answer to that. What we've got to do, though, I think, in this regard, is making sure that risk and reward get reunited, as it were, and sequenced properly. If you take the risk, you get the reward, but you can't get the reward and pass the risk on ultimately to the investors who lost everything, at least in part because the bond raters gave these financial instruments such high ratings that were just fantasy.
All of those are good. But are you willing to still support the notion of capitalism?
Oh, absolutely. But it's got to be capitalism, and that has to do with risk and reward being, again, reunited and sequenced properly, not allowing people to take risks with other people's money and reap the rewards. But if it's a loss, well, it's somebody else's loss.
Right. It's very reminiscent of an interview I had just a couple of months back with Charlie Gasparino, was CNBC, now Fox News, the author of a book that's still out. And it's a similar question I'll ask you. Given all that has gone on and all that continues to go on, we'll get to the present here in a minute, is Wall Street broken?
Oh, absolutely.
It is.
I think there's no question but that it is. I think that most people have lost confidence in it. Nobody likes to be played the fool. Nobody wants to be the chump. Imagine that you went to the track in Saratoga and you did your research. You looked at the records of horses, you looked at the records of jockeys, you looked at track conditions. So you're not doing anything like betting because you like the color of the silks, right? You're betting on the basis of actual research. We could call it due diligence at the track, okay? Now, suppose your horse does not win. You lose your money. You're in the bar afterwards, and you overhear a conversation, the owner, the jockey, the trainer, and you discover in listening to this that, in fact, they were, what they did is decide that they wanted better odds on the horse the next time out, so they held the horse back. Okay? So due diligence came to absolutely nothing. And that, I think, is the problem that we face.
Okay, but here's a problem then with all of that, because, and I don't know whether we can agree or disagree on that, but let me throw this at you. Whether or not that's the case, would you not agree, no matter what goes on Wall Street in any given finite period, in the long run, Wall Street is very beneficial to Main Street. Would you not agree that Main Street, in fact, needs Wall Street? We don't think about it in those terms, but what we do almost every day, whether it's buying groceries, buying gas, somehow or another, Wall Street influences that.
I don't want to be disagreeable, but I do absolutely agree that it does influence Main Street, and I do think about it a lot. Indeed, that's the approach that I take. My background is in social and political philosophy and philosophy of law and business ethics, so I approach it from that way. What are the connections? It's not as if we woke up one day and here was all of Wall Street as it is now. It is a social institution. There are things that have to be done. We need to raise capital. We need the financing done. So I am prepared to look at the various functions and sort them out. So we absolutely need the financial system. Now, whether we need high-speed trading, where my computers and quants are betting against your computers
I can hug you right now.
Has absolutely nothing of social value. It's none of those functions that Main Street needs. I'm an anti-paternalist, so I'm fine if these people want to do that. Leave me out of it.
Let's wrap up with a couple of things. Goldman Sachs has been pushed on the back burner here momentarily, but they've been in the news. Holy cow, what's going on at Goldman? And just a couple of Thursdays ago, the so-called flash crash. Again, I think we're going to agree on this. These and other issues continue to erode the confidence on Wall Street.
Absolutely.
How do we get it back?
Well, we have to be careful with, excuse me, allowing people proprietary trading in banks like Goldman Sachs, where they are both making a market in a particular financial instrument and then also shorting it.
But you know, there's always somebody on the other side of the trade. You know that.
There always has to be. You can't have a trade. If they are simply making a market and bringing together buyers and sellers, no problem. If they're doing that and they're simultaneously promoting one of those instruments, they're encouraging people to buy it, and yet there are other people at Goldman Sachs who have bet Goldman Sachs money against it, that it's going to fail. That's where you get the problem, and that's why you can't have confidence, and that takes us back to Saratoga.
The horse race.
Yes, exactly. They're going to make sure that the horse loses.
All right, lastly, as we're slowly getting into the summer months here, I hope, as you're looking into the summer and fall, what other problems are out there? What are you looking at? What are you concerned about? What will you be writing about in the next couple of months?
The main thing that I want to focus on is how we got into the mess from the very, very beginning. What was behind the deregulation? What was it that was driving Alan Greenspan, for example, to go along with such deregulation? And what he has said is he was astonished that the investment banks did not act in their own self-interest more carefully. And that's what catches a philosopher's ear. What is Goldman Sachs, for example? Is there a single thing that is Goldman Sachs that has an interest that it needed to protect? And in point of fact, no. Goldman Sachs has many different functions, and as we were just talking about, you've got some portions of Goldman Sachs urging investors to buy, and you've got other portions of Goldman Sachs betting that these instruments will fail. So what is Goldman Sachs? What is the interest, and how could it act in its own interests? And how is it that it could act in its own interests and do so well that we don't need to regulate it?
Will you come back in the fall and tell us what Goldman Sachs is?
Oh, I absolutely will.
I appreciate your time with us and for coming in so quickly. Thank you very much, Professor Jonathan Schonscheck.
Delighted to be here.